Gold hit fresh all-time highs last Friday, and it's lingering right around those highs even today. We're going to talk about gold and how to trade it with options today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. As I mentioned just a second ago, gold hit fresh all-time highs last Friday, around 2,700 bucks an ounce, almost. We're getting up to these kinds of levels pretty soon, it would seem. Around 2610 right here and now. And one of the things that occurred to me was that we might be getting a little bit close to short-term stretched, although I still like it. So let's just start with that. The fundamentals for gold remain intact in my view, which is that when you have a lot of money printing, fiat currency, and the fact is that governments try to create some measure of inflation, which means that the value of currency goes down. One of the best safe haven assets through history has been gold. And it's interesting, Carter Worth, my CNBC colleague and friend, was on Fast Money last week. It may have been Friday, I'm not sure which day it was, but he made an observation, which is not something I'm going to be able to show because unfortunately my gold data on the Bloomberg terminal does not go back as far as he was talking in his data. Let's actually find out how far back I can go. I'm going to just extend this and see how far back in time this data goes. And the reason this creates a problem sometimes, it looks like it's actually only going back about 5 years, is that when you get gold history, I should probably try to see if I can find this gold spot price. On the terminal, it's basically chaining together all of the most active futures contracts in history through time. So that's how it creates its time series. And so consequently, we don't get historical gold prices going back a century or so because, of course, these futures don't go back that far. By default, I usually look at the COMEX gold future. But one of the observations he made, which was actually news to me, and I know that there's some, I'm not going to say anti-correlation, but not necessarily positive correlation for gold and other types of risk assets at all times. And there's a couple of reasons for this. One of the reasons is that holders of gold, physical holders of gold, don't typically sell their gold in times of stress. So if somebody has physical gold in a vault, they don't start unloading it when things get woolly. So what that does is it creates some stability for the asset because those that would be inclined to chase it during those times or want to own it as a safe haven asset are buyers, but there's not a natural seller amongst those who have held it for some time. Now there are some market participants sizable market participants who have helped to create some stability in gold prices. Among them is actually the Kingdom of Saudi Arabia. So Saudi Arabia, and this is interesting of course because Saudi Arabia's wealth is commodity driven, but they have often, their central bank has often purchased gold when prices have dipped and sold it when it has ripped. So they've sort of acted historically as a little bit of a market maker, creating liquidity, creating a bid when the price fell, and being a natural seller as it rose. And recently they haven't been doing that. Pretty much the trend amongst all central banks and governments has been to repatriate and to purchase. So last year, central bank purchases around the world amounted, and I'm going by memory here, to about 1,037 metric tons. So a metric ton, obviously 1,000 kilograms, it's about 1.1 US tons if you're trying to do the math of converting the 32,000 ounces per US ton into a metric ton. So because we tend to talk about it in per ounce prices. Saudi Arabia actually has been purchasing. Now, I think it was the World Gold Council. There's a couple places online that you can go to get information on central bank purchases. You can probably just Google it and it will lead you there. But that creates a natural floor. And of course, inflation has created a reason to want to own it. And you put those things together, and that's one of the reasons why at the beginning of the year on CNBC on Fast Money, we're all supposed to come up with an acronym, and that acronym is supposed to be, our top picks for the year or whatever. Now, in theory, we should be permitted to update that and make adjustments and trade around it, ideally. We do not. You just basically get to pick an acronym and run from there. Mine was BRAVE, and the A actually in BRAVE was for AU, so the periodic symbol for gold, because again, I think these trends remain intact. So the thing that Carter had said about its not uncorrelated, it's not anti-correlated, but its uncorrelated nature and its value as a safe haven asset, according to his data, in all of the S&P history where there have been drawdowns, peak to trough drawdowns of more than 20%, so technically a bear market, which I think he said there's been 14 or 15 of these in the history of the S&P. In every case but one of those, gold actually rose during the period, which is pretty extraordinary. It's even more extraordinary when you consider that the total return for holding gold since 1998 has matched the total return for holding the S&P 500. That's net of dividends. Again, I'm going off of his data for this. I'm probably going to find a source where I can actually pull down a time series for gold so I can analyze this more closely. But I trust his work, so I'm just going to cite it since that's where I'm getting it. So while I was contemplating the fact that this recent run, so I don't know if you can see my chart right here. I'm just going to pull up gold year to date, and we can see that it's had quite a run, and actually just from this trough right here, back on Valentine's Day, we can see that it's up almost 26% year to date. I did notice that the most recent rally seemed fairly sharp. And so I was just wondering whether it might be due to pause or even pull back mildly as part of a broader uptrend. And so I was taking a look at RSI. Now it's interesting because when I was looking at this last week, I think it actually ticked over 70. And by the way, I'm using a 14-day RSI, but this looked like it had triggered, which to me suggested that while I still believe that the longer-term uptrend is intact, and more than that, I believe that the fundamentals remain intact. I mean, remember, one of the other bits of news we got recently was that U.S. federal interest payments are estimated to be in the neighborhood of about $1.2 trillion for this year, which is an extraordinary number, and made more extraordinary by the fact, of course, $1 trillion today is not what $1 trillion was a decade ago or 2 decades ago. But on a relative basis, what's extraordinary about it is that interest payments are actually exceeding the U.S. government's military spending. And this is a pretty profound and remarkable set of circumstances. You add to that we have 2 presidential candidates right now who appear to be falling over themselves to try to offer handouts of one sort or another to the electorate. And, we've got the most recent one from Donald Trump, which was that he was not going to tax overtime, which is quite extraordinary. And of course, we already had Kamala Harris following on Trump's promise not to tax tips, and also to give $25,000 to first-time home buyers. I mean, just opening up the public coffers as if there was anything in there. And this money, of course, where does it come from? It is printed money. And if you have printed money, then the value of the money goes down. That is the natural course of things. And actually, what is also interesting is that, the value of a dollar, since we went off the gold standard, and I'm not talking about Nixon taking the last vestiges of the gold standard away, but since the creation of the Federal Reserve back in 1913. The value of a dollar has lost 99% of its value. And when you realize that, you know, the average home was, call it $1,200 back in those days. And, you know, the average annual income was measured in hundreds. You know, you combine these things and then you take a look at the price of gold. And by the way, the regulated price of gold, because we were in a gold standard at that time, until FDR made the first adjustment, was $20 per ounce. So, you know, do that math and you multiply 20 by 100 and you'd get to 2,000. We're a bit above that now, but I think we are also at a point where the average home is more than $120,000, which is 100 times the $1,200 that a house cost back then. So when I say it's lost 99% of its value, it's actually lost more than that. And that trend will continue for as long as the electorate demands things from the government, and the government does not have the resources to pay for it, so it prints money. And this is what happens. So that fundamental story, unless you happen to believe that that is somehow going to change, then you have to appreciate that its value as a safe haven asset. So bearing that in mind and taking a look at the RSI, which according to this chart, so I have it up on my screen again, like I said, I thought I saw this thing tick to 70 on Friday. It's about 68 now. So this is what I was keeping an eye on as I came up with the trade I'm going to describe to you now. But before actually, let's do this. Let me show you one other thing before we get there, and that is the term structure. So I'm going to just take a look at the term structure for gold. Actually, we'll do it for GLD, because that's actually where we're going to be doing this trade, because I know not everybody is set up to trade futures. And by the way, just one quick point, if you did want to trade futures, that's totally fine. You want to trade options on futures, also totally fine. There will be some alignment in the pricing of these instruments. You know, arbitrageurs are going to, keep these things relatively together. But I appreciate that not everybody trades futures or has a futures account. Now, in some cases, trading an ETF, which is what we're going to be looking at, and trading the futures is not the same thing. And the examples of that are going to be any situation where the underlying commodity either can be difficult to store or transport, anything like that. And the reason is because the forwards can be completely disconnected from spot. In the case of gold, it's not. It basically is as simple as carry cost, which is storage and insurance and things like that. If you're dealing with electricity, where supply and demand can get out of whack in the short term very violently, or if you're dealing with something like natural gas, where supply and demand can get out of whack periodically, but quite severely at those periods, like on the shoulder months, trading an ETF like UNG is not a good proxy necessarily for trading the specific futures you're trying to target. But in gold, it's okay. So I just wanted to make that point. I think GLD is a fine instrument as a proxy if you don't have access to futures. Good for this one, not good for every future, so let's just bear that in mind. By the way, we used to trade the gold futures and options on those futures on the COMEX. So when I was at Bluefin Trading, our commodity operation operated on the NYMEX and the COMEX. But for those who don't know, those exchanges were basically all wrapped up. The New York Board of Trade, the COMEX, the New York Mercantile Exchange, all of those New York commodity exchanges were essentially rolled up, and actually the building was all at One World Financial Center in Lower Manhattan. And it was just a quick escalator ride between the energy floor, where oil and gas and the products traded, and the COMEX, which is where things like gold and silver traded. Anyway, so we did trade this product and trade it against the ETF. That was Bluefin's very big in the ETF business, or at least it was. So, I have a little bit of experience with this when I just make these references, just so we're all on the same page. Okay, so if you're looking at this chart, what we're looking at now is the term structure of volatility for GLD. So on the left side of your screen over here, These are the near dated options, and on the right side of your screen, these are the longer dated options. Now, under normal circumstances, for most stocks, what you're going to observe is an upward sloping volatility term structure. And to illustrate that, actually, we've had some volatility of late, which is going to disrupt this a little, but I'm just going to put SPY in here for comparison's sake. And so what you can see is, you'll notice that the longer dated options premiums are in vol space higher than the nearer dated ones are. And that's not necessarily true for gold, as you can see here. So you can very clearly see that the longer dated equity vols are higher and the shorter dated equity vols are lower than they are for GLD, and the opposite is true for GLD. So why does this matter? Well, the reason it matters is because what I was going to talk about was using a calendar spread to make a bullish bet and selling a nearer dated strangle to buy longer dated options. So let's just take one quick last glance at this. So it doesn't matter terribly which one you choose, but let's just say for the sake of argument you wanted to own out to June of next year, which would be fine. I mean, I was actually taking a look, I think, at January, but let's just take a look at June. And, try to create a situation, because one of the things, of course, is that gold doesn't pay a dividend. It was one of the big complaints that Warren Buffett always used to have about gold, is you'd say that gold just doesn't do anything except sit there and look at you. Doesn't make any money, but, with all due respect to Warren Buffett, if you had bought gold in 1998, or if you'd bought the S&P in 1998, it'd pretty much be a push. And you don't really have to worry about whether or not there's any accounting shenanigans with gold. Well, actually, some conspiracy theorists would probably argue that you do have to worry about that, but we're not going to get into those kinds of complications for now. So, buying some longer dated options premiums, oops, that's an Oracle. We are not looking at Oracle. We are looking at gold. And more specifically, the gold ETF, GLD. So we're just going to do that. So buying longer dated gold calls, we're at 238. I don't know that it really matters, but you could, for example, buy an at-the-money call if you chose, or even go just slightly out, which would be fine too. This is around 20 bucks. Why don't we just pick the 245? So just up slightly from where we are currently. And then selling some near dated premium against that. A call and a put is my thinking. Now, you may ask yourself, well, if you think that it's getting close to being overbought, why then would I be comfortable selling a downside put? Well, we're making a bullish bet. We're just making not quite as bullish a bet as just going out and buying the underlying or buying a call option. The other thing I would say is that significant pullbacks in gold are relatively rare. So I was looking at selling a put that was about 5% out of the money. So we're at 238, that's going to be, we're going to call it 12 bucks or whatever. I mean, if we go down to 225-ish or thereabouts, we can probably go a little higher than that. We can go down 10 bucks. It's pretty close. And then a similar amount to the upside. So it turns out that moves of 5% or more to the downside in gold over the course of any 30-day period are quite rare. I mean, you're talking about a 1 in 10 shot. And even if it goes down that much, you're going to be effectively buying it at 4.5%, 5% discount to the current price, and we're comfortable owning gold, right? We want to own it. So here we go. We can sell another 10, 12 bucks up. Let's look at the 250s then, something like this. Okay, so there you go. So collecting about 10% of, oops, and there's we don't need to go out actually all the way that June. Let's just go to this June here. like that. In case we don't want to lay out quite so much premium. Now, bear in mind that, of course, you have the benefit if you end up buying a leap. You could be subject to long. I'm not giving any tax advice, but the reason that there are leaps is so that people can have long-term capital gains. If you're doing this in a tax-deferred account, then this isn't necessarily going to matter. And by the way, in a tax-deferred account, so something like a self-directed IRA, this is a trade you should be eligible at many brokers to do, because the short call is covered by the long call, and assuming that you have sufficient cash in the account to cover the purchase of GLD at the strike, net of any premium collected or spent, then that should also work. But if you take a look at this, so basically buying a long-dated call that's got 287 days to go, $13-ish, round numbers. We're selling this for a little over $2, and this is going to get a payoff profile rather like this. So still bullish, but you're increasing your probability of profit. And so one quick point, I was looking at the RSI. When the RSI gets over 70, the 14-day RSI for gold gets over 70. So the 30-day average return for gold is about 79 basis points for the period that I was looking at. And that was just for the existence of GLD. So in case anybody's wondering, Mike, you said since 1998, the total returns for gold have been roughly comparable to the S&P. I have not that long ago mentioned on more than one occasion that the 30-day total returns on average for the S&P are about 85 basis points since 1990 or 91. The reason there's a slight difference is because I'm not syncing up those times exactly. I don't have the history going all the way back. But it should not surprise you that the 30-day return for gold on average is close to 80 basis points when I'm telling you that the 30-day average return for the S&P is close to 80 basis points. And I'm also telling you that the total return for the S&P and a gold holding from late 98 to present is about the same, right? So that would make good sense. What is interesting is that when the 14-day RSI hit 70 on average for this period that I had, the average returns for gold actually dropped to about 37 basis points. So doesn't mean that it's going to go lower. And the probability of profit also dropped to around even, give or take. Might have been still slightly positive, 52, 53%. But that's the reason. That's the reason we would do a trade like this, try to collect a little bit of premium, lean bullish. We're just using the context of the possibility that it's getting stretched. Now, I would point out that actually the RSI is not 70 right now. And that was that's the number that I was using in my testing. So just keep an eye on it. I'm sure all of you have access to RSI, and you can do that. Okay, so with that, I am going to hop over here and see whether we have some questions. And we do. Ranjana Gupta, welcome back. Good to see you, virtually, of course. What do you think of an October 18th, 37.5 cash secured put on SLB, SLB, Schlumberger? Did that question pop up? I don't know if somebody can get my ear and just let me know whether I'm sharing that, but hopefully I am. Okay, so let's just take a quick peek at Schlumberger. So oil obviously been kind of a tough go for oil recently. Not that surprising given the fact that we have, this is not what I want. That's going back way too far. So that was just looking at quarterly prices, but here we are. So this is Schlumberger, obviously in a bit of a downtrend here. And I'm just going to get rid of multiple moving averages. I think it's only necessary to look at one. We're just going to look at the 150. Unless you're looking for something like a Death Cross, Golden Cross, whatever. But neither of those are actually at play here. So, first of all, I like Schlumberger and I like Halliburton as companies. I think a cash secured put as a way to, start dipping your toe in the water probably makes some sense. Let's just take you didn't specify what expiration, but why don't we take a look at that? So first things first, let's just take a look at what events are on the calendar for Schlumberger. And I'm not going out far in time, it would seem. Oh, whoops, I don't want just sales result, I want everything. Here we go. Okay, so we're going to be getting earnings on the 21st of October. And I think October expiration is actually the 18th. So in much the same way that I'm not crazy about selling covered calls going into an event, selling cash secured puts is essentially the functional equivalent of a buy right? So if you sell those Octobers, let's see what we can get for those. And okay, I'm going to just only look at the current. All right, we're going to see a big pop on the, oh, look at this. That's interesting. So the options market's actually got a good bid to those, 33 vol. What worries me a little bit about this is that if Bloomberg's estimated earnings date was correct, the Oct. 25th expiration weekly options should, in theory, have a higher implied volatility. So before we do any more work, let's just all make a mental note of this, that, and you all might be using a different source for your estimated earnings dates, but Bloomberg's estimated earnings date of the 21st doesn't jive right now with what options prices are implying. So the options market appears to be implying it's going to be before the 18th expiration, or in theory, why would it be after the 1st of November? That would be awfully late. But notice that so you've got a lot of volatility coming up associated with the election. So this term structure that you're looking at here is an interesting one. You see all of these jigs and jags. What's going on here? So if the options market implied that earnings were actually going to be on the 21st, as the estimate from Bloomberg and probably some other sources have it, we would expect October 25th expiration options to actually trade at a higher implied volatility, and they don't. So make a mental note of that. That's not about Schlumberger necessarily, but just something to think about. The other thing to think about is that the November 15th options are trading at a higher implied volatility still. So it would appear that as far as the options markets are concerned, the election, because that's what happens. What is happening between November 1st and the 15th that we all can identify? The election, right? And we have two candidates who have expressed historically very different views about the oil business. And of course, Kamala Harris has more recently been changing her tone, saying that she is not opposed to fracking, but that her values haven't changed. And this is interesting too, because Pennsylvania, which does have a decent bit of fracking, is certainly one of the important swing states. So something to keep your eye on. Okay. If one thought that earnings were in fact going to happen after the 18th, then I would really like to sell that expiration, because essentially you're getting a bid for those options that are otherwise undeserved. So we can take a look back. Last year they reported on the 20th, prior week on the 21st, prior on the 22nd, and then we had the 16th in 2020. So the 20th or later, each of the last three October Q3 reported quarters. And in each of those instances, the prior quarter fell. So we had the 21st, this time the 19th. Before that, we had the 22nd, 23rd, 24th. And here we go. So here it was the July 19th. They reported Q2 2019, and they reported on the 18th. So if they were going to try to, basically space out these earnings by about the same amount, we might think that they're going to report a little bit earlier. It's possible. So something to think about. But in general, I rather like the strategy of cash covered puts, particularly if you can get a decent implied volatility. And we're looking at some pretty cheap multiples for this thing. Good, solid free cash flow. Street is still looking for good top line growth, and I'm assuming, Ranjana, this is why you're probably looking at the name anyway, right? So I think less than 10 times full year 2025 earnings let's assume this is a little bit ambitious, and maybe it's not going to be as good as that, but even if you were getting 8 to 10% top line growth, I think that would be a very reasonable number. And in its historical context, I mean, it's, a lot of times we look at things only in terms of their multiples, but we're not really looking at them in terms of, how big these companies have gotten. So NVIDIA would be a good example of this. It's now a $2 trillion business. Here we're looking at a less than $60 billion company that's going to do $37 billion of revenues this year. And back in 2022 is 20 billion. I'm sorry, what was that? Somebody was reaching out to me there. Yeah. So, 37 and a half. I like it for October 18th, but there is a chance that you're going to get earnings. So that was a long-winded way, but I definitely had something. Okay, so T is moving higher. Is it time to write that covered call? Yeah, AT&T, I mean, this is basically a yield play, isn't it? Now, I want to just bring up a balance sheet I'm not even going to show a balance sheet. What I'm really showing you is, well, actually, I want to show a balance sheet. What the heck? If I can get it to go over there. There we go. So an important thing, this is true for Verizon as well, I should just say, and that is that these guys have legacy businesses. It's one of the reasons their growth isn't that great, and they have a heck of a lot of debt. And it is because of these massive levels of debt. So $407 billion in total assets, and we just take a look at the total liabilities, and you can see $288 billion. So that's a lot of debt to equity. And actually, it's kind of a short way to look at this. Just compare our market capitalization to the enterprise value as a back of the napkin way to figure out how much net debt there is, right? So if you deduct the enterprise value of a business, that way you don't have to go through their preferreds and cash and equivalents and various types of debt that they have. If you have a $160 billion market cap and a $320 billion enterprise value, you've got $160 billion in net debt. 160 minus 320 is negative 160, 160. So if that was a positive number, that's how much net cash they have. Why do I bring this up? It is because when you sell options, you are selling options on equity, and how volatile the equity deserves to be is a function of the volatility of the underlying business and the leverage on the balance sheet, both. And the only thing that worries me a little bit about getting, short too much premium in this is that, we're looking at full year forecast of free cash flow declining. Now, this is still meaning that their dividends are well covered, their debt is well covered, but this is a pretty remarkable year-on-year free cash flow decline. And if we get a look that's not going to resume some form of an uptrend, it's something to think about, right? You look at net debt, look at free cash, and look at one as a multiple of the other. So that's what I would say about that. However, I will also add that this is a yield story, and we're getting into a pretty testy area. So Brad, I don't know if this is what you were talking about, that maybe it's getting a little bit extended, and so maybe now's the time to, and that's a decent way to trade, right? You're long a stock and you just think it's getting up to levels either where you would be willing to sell it or where you think it's going to run out of gas, sell some upside calls. Again, try to avoid those catalysts if you can. So earnings being the most obvious one. 23rd, I'm assuming that's probably accurate in this case, since that's well beyond the 18th. So, sell some October calls, sure. All right. Let's see. Good afternoon, everyone. I figured the VIX would be a lot higher between Fed tomorrow and the second attempt on Trump yesterday. Yeah, that was interesting, right? It's pretty scary, and you would think that the market would express some of that concern. 17's not totally cheap. I think that's about where we are, right? Just above. Whoops. Am I typing on the right keyboard here? I think I am. Okay. I think I might be having some kind of a weird display issue. It's not recognizing that. Let's try this one more time. VIX index. Give me a number. How about on another screen? And I'll drag it over if that one's not working. Okay. So not sure why that screen didn't want to do anything, so I'm going to bring this one over. And we'll see what's going on with that in a moment. There we go. So we have a little bit of noise in here from that big spike, but you can imagine if you look at this number down here, we're still well above average, right? So you kind of have to ignore that as a bit of noise, but if you just take a look at these longer term averages, you can see that we're well above it. And the principal driver for the VIX is going to be two things. One, of course, as you rightly point out, is that there will be some catalysts. Those catalysts can get priced in, so if we see that coming. But the other thing that's going to be the big driver is realized volatility. Options market makers are very interested in how volatile stocks actually are. And for that, we can take a look at the 30-day realized volatility. That's this number here. Okay? So we're going to expect that the VIX should have some relationship to realized volatility in the S&P, because that's essentially what's getting traded. So we'll back this up a little bit, and let's just take a look at this relationship through time, bearing in mind, once again, we've got a couple data points in here which are a little bit screwy, but sure enough, we can see that that's the relationship. And realized volatility right now on a 30-day trailing basis is 15.6, and the VIX is 17. So you might think that folks would start bidding for some insurance given some of the weird things that are going on around the world, including that second assassination attempt. But you also have to see how much realized volatility is going with it. Because from an options market maker's point of view, if I pay 15 vol just to keep the math easy and it realizes 10, I'm essentially losing 5 vol clicks, right? So for 15,000 Vega, I lose $5,000. And you're going to see these things track pretty closely together most of the time. So if you want to see the VIX go up, you're probably going to need to see realized volatility go up. Now, a quick point, and that is that the VIX can be highly reactive to short-term volatility swings. What I mean by that is you can see that 30-day volatility is smoother than the VIX. 60-day realized volatility is going to be smoother still. See here? 90-day volatility will be smoother still. They're still going to track, but the longer the period, the number of pieces of data you're looking at, the less any one of them is going to make an impact. So what's interesting is that even though the VIX is a look ahead on 30-day realized vol, look at that. It actually behaves much more like short-dated volatility. So this is 10-day realized in this case, which is basically 2 weeks because the realized is based actually on trading days, and the VIX is based on calendar days. So you can see that these actually track much more closely. And what's going on here, and that's 5-day. So what's going on here is that the 1-month forecast is actually being largely driven off of what's going on right now. So it's sort of auto-regressive, meaning that the most recent events are going to weigh much more heavily as they make a volatility forecast. So I'm not saying this is the best way to model volatility, and I'm not even saying that this is the way that people do it anymore, but it is a way that they did do it for a while. They use something called a Garch model. And basically what you were doing is you were taking a look at how things were behaving, but you weighted more recent events more heavily. The idea being that the best forecast that you have for near-dated vol is the vol that just took place. Okay, so yeah, let's go on to the next one here. All right, question 1 of 2. What is your playbook for managing options? You buy back cheap written options. I'm buying longer-term calls spanning next earnings and selling 30 to 45-day calls against them. Okay, so that's the first part of the question. And the second part of the question, this from PC, is after 30 days, usually the spreads are out of whack. Roll up and out if target is higher. What if the long call goes down substantially? Do you have a good rule for managing these spreads? So just these are rules of thumb, things that I usually get my eye sort of looking at things. First of all, delta. I've mentioned this before. Once an option goes over 60 delta, whether it's long or short, often I'm looking to see whether it might make some sense to roll or adjust that position at that time. For the following reasons. If I am short the option and my hope and expectation was that it was going to expire out of the money, once the delta is over 60, the options market is telling you that there's a better than not probability that it ends up in the money. So the initial thesis is now appearing to be broken, or at least the options market is telling you that that's the statistical likelihood, that your initial thesis was wrong. On the long side, the reason I do that is because I want to have some measure of convexity. And so if I bought an option at 30, it goes to 60, I'm preserving my view. I might push out or push out, up and out to a 30 delta option, for example. So that's the first part. A lot of people have very basic rules about closing long options based on premium. So I think, my friend and colleague from Options Play, Tony Zhang, I don't remember if he says 50% of the premium or something like that. Dan Nathan likes 40, I think is his number, and he just uses it as a simple stop. So buys an option for $3, declines 40% or $1.20, so now it's worth $1.80. He just takes it off and reassesses. Now, in calendar spreads, it may be not quite so clear though, and I tend to like to trade around the short side. So for example, if I bought a $3 option and I sold, let's say, an 80-cent upside call up against it, and now it's down, and that $3 option is now trading $1.80, so it's lost 40% of its value, but I can cover that short call, the 80-cent call that I sold, for basically a nickel. So I, basically realized the 75 cents, still down net 45 cents because the $3 option is trading $1.80. If I still have, let's say it was a diagonal call spread or a straight upside call calendar, if my underlying thesis remains intact, this is when I often like to leg into a diagonal risk reversal by selling a shorter dated put against it now that the stock is lower. Because, in an ideal world, we would love to buy long dated calls and then sell short dated premium against it, but have strikes that were so far away from the strike of the call that we bought, that basically we think there's little likelihood of assignment. Well, it's rare that you actually get that in the moment. But it is less rare that you get a situation where you make a bullish bet, the stock kind of gives some back, so you can close the short nearer dated call for a credit. But now you can actually say, you know what, I had some conviction before, I've got greater conviction now, so maybe I can look to sell a downside put at this point. And because those downside puts that had no bid because the stock was higher now have one, right? So the stock's come back, so maybe I can sell a put that I would have liked to have sold at the time that I initiated the trade, but it was just too far out of the money, had no real extrinsic premium. So that's another way to manage it. And if you wanted to sort of get it to a level where you still had some upside participation, you could also roll the long call strike down at that point. But again, 60 delta on your options, long or short, is a good time to sort of take a look at it. And again, the circumstances will vary, because if it's a catalyst, for example, that do you have new information? But I think that's helpful. Okay, Ranjana Gupta back again with another question. I found a website which gives the theoretical value as well as the last trade of each contract in an option chain. How would this be useful to me? Well, I don't know. The last trade isn't... So it depends how active the option is. If you're looking at actively traded contracts in NVIDIA, it can be somewhat indicative. Here's the problem. A lot of options trade by appointment. Somebody was talking to me about an option recently. It was Williams-Sonoma. So this is probably not something that trades huge amounts of contracts. Here we are. So I'm sharing my screen right now. Hopefully you can see this. 1,600 contracts traded today in Williams-Sonoma. Okay. So let's go take a look at an option and try to figure out where this information could have some utility. All right, so here we are. Let's look at the October 145 calls. I don't know, hopefully you guys can see these on my screen. I'm highlighting them with my pointer here. 7 bid at 740, so a 40-cent wide bid-ask spread, pretty wide spread. Last traded 705. Now, if you saw that trade was recent, you begin to get some sense of where an inside market might stand. Now, if you can also get the theoretical value for the option, and I'm just going to use a calculation mode, so there's going to suddenly be a little bit more information on my screen. So I have a theoretical value. So my theoretical value for that option is $7.14. So if I know it traded 705 and I've got it worth 714, and I'm going to say, okay, well, I'm selling it 9 cents under fair value at 39.85 vol. That could have some utility. The problem is that in some cases, you're going to be dealing with an option perhaps that has not traded at all lately. So that last price may have nothing to do with anything, right? Take a look at the 155s. We were just looking at the 145s. Now we're looking at the 155s. Well, the 155s, the last was 350, but they didn't trade today, right? The options are 285 at 340. It doesn't really... I mean, I'll tell you that I've almost never looked at the last. Right? Now, bear in mind, though, that, I'm a former market maker, so the last price is just... I don't really care about the last price. I care about the theoretical value, and I make a market around that. And if I'm a better buyer, maybe I'll just be a better bid than the street. Better seller, I'll be a better offer than the street. The last, it's not that relevant. Where it becomes relevant is if you're trying to put up a big block, you want to see where the last big block went up. It gives you some sense of where real liquidity could be found. If you have a really wide spread and you're trying to figure out where the inside market is, so what's the inside market? Those are the prices where you could reasonably expect a limit order to trade well inside the posted bid and ask, right? So we also call that the touch. So if a market is $5 bid at $6, wide spread, 20% of the value of the option, or almost, I have no interest in just hitting that $5 bid or lifting that $6 offer. Actually, I think is it DR Darden Restaurants, I think, is another one of these names that we've actually traded And you can see these wide spreads. So then I'll look at to see where the last was, just to get a sense of, yeah, so yeah, again, this is pretty wide, right? 480 at 520 for the at-the-money 160 calls out in October. 495 last, right? So, you know, you then have to sort of see when those traded, though. So you can go and take a look at time and sales. So that's how I would use it, but I don't really look at the last that often. Theoretical value is a little bit more important to me. And I will try to set my limits at that. So for example, if my theoretical, well, let's take a look. I mean, my theoretical on those is 480 at 520, and I've got these things worth 484. Okay, so if I was shown a 510 offer on good size, I wouldn't be overwhelmingly enthusiastic about that. If I got shown a 480 bid, which is actually the lit market bid, if I have a 484 theoretical value on good size, so say someone says 480 bid for 1,000, that's a good bid. I mean, it's just 4 cents below theoretical. So theoretical is very important. And it should also help steer you away. You know, you can find, you know, if you think your vol surfaces are in a good place and you have good theoretical values and you want to sort of prod and just sort of see whether you can get something off close to theoretical, go ahead. The last price, you know, I wouldn't worry too much about that. Okay. Let's see here. And how far along are we? Ooh, we're almost an hour in. Ooh. Okay. Now that Adobe has reported, what are your thoughts on a 500 480 short vertical with additional funding through a short 550 call Oct. 4th? Yeah, I like selling premium on Adobe. And by the way, you know, we talked about that strangle swap in there. Come on. What is going on with this keyboard? And we were looking, okay, so this trade, notice it basically went right to the put strike of that. So that trade kind of worked out. But this is one of those situations where you probably want to take that thing off and not play too many games with it. Get the vol crush. And remember, the strangle swap, it would have been better if it had gone up by the implied move or a little bit more rather than down. It was structured in such a way that it could make if it made the implied move up, that was a good win. If it made the implied move down or a little bit less or a little bit more, you'd come out ahead. But that's not what you were deploying the capital for. That rate of return was not what you were hoping for, but it turned out okay. But now you have, you know, these options, including that long-dated call option that's pretty far out of the money at this point, right? Because we were looking at an 8% move, $40 off of 580, so it was up around 610, 620. And I think I showed a couple different examples when we talked about it. But, you know, this is a trade you probably want to close. But now that the news is out, I like to usually wait, though, for at least 3 days. My reasoning on the 3-day rule, you'll hear other guys talk about it. Big institutional holders, you can't just blow your position out instantly. And just to illustrate that, let's just take a look at some of the bigger institutional holders here. You know, I mean, Geode, well, look at the size of their position, 10 million shares. You know, the thing only traded 5 million shares today. So if they're figuring out what they're going to do with their Adobe position, net of the new news that they have, it takes time to start putting that into motion. And they're going to work out of that position, if they're working out of it, over some decent period of time. Maybe not. Their, you know, view on it may have remained intact. I mean, over the previous quarter, they had bought 200,000 shares. But that's usually what you're waiting to see over that first few trading days, is just looking to see whether real money accounts, which I'm usually talking about the mutual fund companies, Fidelity, State, you know, those types of outfits, Wellington, you know, Waddell, those kinds of guys. If you see them starting to sell, it could put prolonged selling pressure, and that's why I want to give it sort of 3 days. If it dips and then starts to catch a bid almost immediately, that usually gives me a sense that, you know, they're not turning seller and might even actually be using it as an opportunity to acquire more stock at a discount. And ultimately, you know, they can create prolonged support for or resistance for a stock because they just represent positions that are so substantial. So that's the only thing I would say about that. I like the trade, risk reversal using a put spread, but you know, let it sift, and we can see that. I mean, today, you know, it's short sale restricted, another pretty weak day, underperforming. You can let it breathe. You don't have to race into it, but I do like the strategy in general. Okay. I think Tesla will disappoint on or before the Robotaxi event. Any thoughts? Short the November 230, 270 call vertical and long the November 200 puts. All right, so the math is usually working for you on a short call spread due to the skew, which we like. Let's see how that one specifically stacks up. Get over there real quick if I can. Oops. Did I spill something into my keyboard? Maybe that's the reason I'm having these issues. All right, so you were looking at November. I'm just assuming these are November regs. 230, 270s, so we're just going to say sell these, buy these, 270s, and we're going to buy a downside put. You were looking at the 200s. Are you getting that off at close to even money? Oh, you're collecting. Oh yeah, I guess that makes sense. You would be, wouldn't you? Because you're selling basically an at-the-money call. So yeah, I mean, this is you know, you're collecting. It's a 2-month trade. You're collecting about 1% of the current stock price to make a bearish bet, and you're limiting your risk to $40, which only one observation I would make about this, which is that I rather think that the chances that it would break out above 270 is pretty slim anyway. We have resistance at 274, and that makes sense because, you know, just looking at this chart, you can see this is back, you know, over here is the prior highs. You would expect us, or, you know, within the last 3 months, that is, you often experience a little bit of a resistance up at those levels. So, I'm going to just let us noodle on that trade for 1 second while I offer an alternative. Granted, has a very different risk profiling characteristic, but just bear with me for a second. So let's imagine instead that we thought, okay, 10% down, which gets you down to what, you know, 195-ish or thereabouts, versus 10% up. So where are we at now? Okay. So then you end up with a trade. Oops, did I do that right? No, I didn't. This is supposed to be that. There we go. Okay. So let's just take a look at these two trades, right? So here, you're going to start losing money on this trade. I'm not saying that they're completely like for like in terms of risk, but you know, this thing's going to start losing all in this region here, right? And it doesn't really start to profit until, you know, you get a good sized decline. Compare that and contrast that with a more targeted trade on the move looking for 10%. And here you're going to collect a little bit of money. And you have the risk of getting short up in this region, but that upside region, remember that we think there's probably going to be some resistance right around here. So, you know, your P&L on that, up around the resistance level at expiration, down $1,300 on a one lot. So $13 or 5%. So half of the upside move on a 10% upside swing versus getting most of the downside participation on a 10% swing. It's just something to think about if you happen to be comfortable shorting stocks. I mean, I will tell you that the robo-taxi thing, I'm not talking about Tesla, I'm just talking about the whole robo-taxi thing in general. I don't talk to anybody who doesn't find this appealing. Now, of course, I live just outside of San Francisco. I see the self-driving cars. I see Waymos running all around. And everybody likes the idea that, you know, you don't get a rude driver who's second-guessing you. In the Waymo case, it's a Jaguar, which is kind of nice. But would I really care if it was a Cruise, Bolt, or a Tesla Model 3 or Model Y or something like that? No. You know, I would have no problem getting into the back of one of these things. And, you know, Melissa Lee made a comment about it. She said, you know, how's this math going to work when they're using such expensive cars? Well, the fact is robotaxis are going to, you can have a nicer car because the most expensive piece of the whole thing is labor. You know, $50,000 car, $60,000 car, runs for a year. You know, minimum wage where we live is, you know, $40,000. Minimum wage for a hospital employee is $50,000. And so you would expect that drivers are going to expect, you know, to make minimum wage or better. And so taking the labor cost out, having a driver that never gets tired, and that statistically is less likely to have an accident, is going to be, you don't have to worry about them, you know, doing drugs. I'm not going to say it's worry-free. You know, these things have accidents. They don't see things, but it's a promising thing. And the fact is, Tesla's got a lot of data, a lot of self-driving data, and I wouldn't count them out completely. They're not valued like it either, in fairness, right? So I can understand it if you are making that short bet. I mean, I happen to be a fan of the company. I'm a fan of Elon Musk. I'm a fan of their products. We are on our second Tesla. I think it's the Model Y long range we have is one of the best value propositions. It's not our only car, but it's a phenomenal value. You're saying more of a play on Tesla, never done anything with robotaxis. Yeah, so that's actually a good point because on the car front, the valuation on Tesla is just really tough to get behind. I actually think General Motors looks attractive. They've got good self-driving technology. They're getting better on the electric front. Not where Tesla is, but they're getting better. And it trades at a tenth the multiple or something like that. So, you know, it's just tough. You know, Tesla, like I said, it's Holly index name. I'm kind of always on board with it. So I'm bullish too. We'll be selling naked puts. Good luck. FedEx. Oh, you're doing FedEx. Oh, FedEx has always been my nemesis. You know, if there's a person, I probably shouldn't opine on FedEx. I've had so many debacles with that thing. Late 22, we owned it going into earnings. Worst earnings result in 30 years. And had other mishaps with that stock. But, you know, the interesting thing is that the fundamental drivers remain intact. I mean, the fact is that ultimately there is a tailwind for their business. But for me, playing them into earnings is just rolling the cubes, man. And I've done it a couple times, been singed enough to just say, you know, I don't know this one and how to play it going into earnings. I mean, I'm probably a great contrarian indicator. So anyway, with that, it appears I have chewed up. Yeah. Oh, okay. Let's see here. Let's just take a quick peek over here at something else before we go. And we're going to try to get a live one in here. I like those. I just need to, I'm fixing some screen situations up here. You guys can probably see me looking up because I have screens now above the camera and I have a couple that are below, well, 3 below, but they're not working for whatever reason. So we're going to figure out what's going on with that. So I think we have a question on Palantir as well. What is your view? You're thinking about buying a Leap, huh? Now that's a contrarian take, huh? That's what that is. But that can work, and I would much rather trade it with options if I was going to make that contrarian bet. This is one of the most loathed names on the street, actually. The average analyst price target for Palantir is 27.65, down 24% from here. And we have 6 buys, 8 holds, 7 sells. So Morgan Stanley's got it underweight. Mizuho underperformed. Deutsche sell. Goldman neutral. RBC, William Blair both underperform. It's got a hold at Jefferies. Citi has it as a neutral. Wedbush, Dan Ives likes it, but he has a $38 price target. I wonder if he's online. I'll reach you. Well, I don't see him on there. Just ping him and hear what he has to say about it. Let's see, actually. So let's take a look at some of the options premiums on a leap. And if you're, I'm assuming you mean like a proper leap, expiration going out 12 months or more, so that it's a long-dated play, which is going to get you out to the SEP 19 calls at least, but probably out to Jan 2026. Let's kill this. And what one were you looking at? You didn't say. So is this thing a... Let's see what we got here. I mean, this thing's it's gonna be pricey. No getting around that. I would also say that if I was going to try to, I mean, that's going to have a lot of decay in it. Even that long-dated one. Even though long-dated options don't decay as rapidly as near-dated ones do, you're dealing with a 55 vol option. So I would consider using calendars here. But, you know, I mean, it is fair to say that sometimes, you know, being a contrarian can pay off. I mean, take a look at Carvana. I mean, that's arguably the best example I can think of you know, of a good-sized company recently where you know, the street had all but left that thing for dead, and you know, they somehow managed to pull it together from an operating perspective and come out the long side. I'm not saying that troubles are over, but I am saying that the opportunity to the upside in cases where you are betting against the broad trend can be extraordinary, largely because you're the only one doing it, right? So the you know, it's just like when you go to the track. If everybody's, you know, betting on something other than the nag you've chosen, if that one actually wins, chances are you're getting really good odds on it, and that's probably the case here. I'm going to try to do a little bit of work and see what Dan Ives has got to say on this one. But yeah, I mean, spread it. I'm okay with it. All right, folks. As always, thank you for watching. Please like, subscribe, but put your comments in. So Wednesday we're going to be doing a live stream, but if you have specific questions that you want me to address on that one, if you put them in ahead of time, maybe we can cue some of that stuff up ahead of time and be more prepared than just my loose thoughts. Okay, thanks for watching.